The BRRRR method of real estate investing continues to be one of the most used strategies in the 2020s. With interest rates elevated yet, property values remain resilient. Finding cash flow with a reasonable down payment is an incredible challenge. However, the BRRRR strategy, buy, rehab, rent, refinance, and repeat, makes sense for a lot of investors, as value can be created through forced appreciation, renovations, and capital recycled through cash-out refinances. With rates high and competition fierce, nailing the financing piece of the BRRRR method has never been more important. This video will explore the loan options facing BRRRR strategy investors, with a focus on the all-important third R, refinance. Specifically, we'll compare DSCR refinance loans to traditional options, namely bank or conventional loans. The evolution of options. With the publication of Buy, Rehab, Rent, Refinance, Repeat, the BRRRR rental property investment strategy made simple by David Green in 2019. The BRRRR method was published to real estate investors, and real estate investing was never the same. In the book, each step of the BRRRR method is meticulously explained, and it's jam-packed with advice, tips, and information, including 2 chapters all about the crucial refinance portion of the process. In the book, Green details all the different options for refinancing. However, DSCR loans are not mentioned. Why? While DSCR loan existed back in 2019, the product was just getting started and not widely developed or available. A lot can change in just 4 years, as everyone on the planet who lived through 2019 to 2023 knows. 5 years ago, BRRRR method investors were generally limited to conventional loans under government-sponsored enterprise or GSE rules and limits, bank portfolio lenders, or other niche options like private money. While these options still remain solid options for many investors, the growth and development of DSCR loans has truly changed the landscape for BRRRR strategy real estate investors. Beginning BRRRR. Buy in cash or use hard money. While refinancing is an important part of BRRRR and can make or break many BRRRR method deals, the first 2 steps, namely buying and rehabbing, are vital to success. Finding deals is one of the most important skills a real estate investors can have, but it's not always enough. Finding a deal and closing a deal are 2 different things. Making sure that you can move fast and execute a close and beat out potential competitors is a prerequisite to successful BRRRR. If someone else is able to purchase the property, your BRRRR investment is dead. Buy in cash or use hard money. Whether due to not being aware of the options, using hard money loans, or thinking it's better financially, in the BRRRR book, Green generally limits the BRRRR strategy to cash purchases, but hard money loans, or loans that are generally short-term and higher rates, have also evolved a lot over the last 4 years. For one, while the hard money terms example used in this book is 14% interest rate and 4 origination points, many hard money loans today will have fees that are half of that and significantly lower interest rates. Additionally, the internet continues to democratize access to information, and hard money lenders can be vetted and compared much more efficiently online, such as Google, YouTube, or websites such as BiggerPockets. Advantages of using cash for BRRRR. What are some advantages of using cash to purchase and fund renovation for BRRRR projects? 1. Lower interest costs. Funding your purchases and renovating yourself saves your interest expense, typically a few months' worth. 2. More competitive offers. Many sellers prefer cash offers over ones with financing because there's more certainty of closing. Financing will typically require lenders' diligence periods, which causes time, such as waiting for an appraiser to visit the property and produce a report, as well as risks of falling through, the same appraiser finding an issue, etc. 3. Less risk. Without interest or looming maturity dates, investors are less stressed if rehabs or the renting process are delayed. Advantages of using hard money loans for BRRRR. However, with these advantages, there are many benefits of using hard money loans to finance the first 2 steps of the BRRRR method that outweighs the cons for many real estate investors. These includes: get started faster. Let's face it, while reading articles like this and absorbing all the podcasts and books on real estate investing is great, jumping in and actually doing your first deal is critical, and what you learn from experience often dwarfs knowledge from all the research sources by far. By buying and rehabbing with only cash, that means saving up all the funds needed for both, often a minimum of $75,000 to $100,000 at current market prices. Most people, let alone real estate investing beginners, don't have that kind of money lying around and can only get started on the financial freedom journey by getting a good chunk of these costs financed by a hard money lender, typically up to 85% or 95% for beginners. Faster portfolio growth. A key advantage of the BRRRR method is to use the smallest amount of capital to build a portfolio as fast as possible. With the power of compounding, doing 3 deals at a time versus 1 at a time can mean the difference of hundreds of properties in a portfolio. As such, an investor funding 120,000 BRRRR buy and rehab in all cash grows the portfolio much slower than an investor who executes 320,000 projects with 40,000 invested in each, with hard money financing the remaining 80,000. Higher leverage on the refinance. Believe it or not, a BRRRR method investors who refinances a hard money loan is looked at more favorably by a lender than someone who bought in all cash. While this may not seem logical, many lenders will give more favorable terms to what is called a rate term refinance versus a cash out refinance. The difference typically defined as whether you take home greater than 2,000 at closing of the refinance, cash out or not, rate term. Many lenders have seasoning, loan amount, and LTV restrictions that are applied to BRRRR method investors only on cash out refinances, and these don't apply if it's a rate term refinance. And perhaps most importantly, BRRRR friendly hard money lenders like Easy Street Capital don't require appraisals for the purchase of a BRRRR property. This allows a BRRRR method investors to be competitive with cash offers and eliminate one of the cash buyer's main advantages. Using a hard money lender like us that does not require appraisals basically eliminates the main advantage of using cash at all: refinancing. Conventional or portfolio lender versus DSCR. There are multiple considerations to optimize the refinancing portions of the BRRRR method. Generally, for the optimal refinance, these are top of mind for BRRRR strategy investors. Return of capital. The key or secret sauce of the BRRRR method is to build portfolios using the same capital over and over, which relies on getting your basis or more back on the refinance, where basis refers to the money you invested in the property, down payment, and cash used for renovations. Speed. Refinance lenders use the term seasoning to refer to the amount of time, typically in months, velocity of money, or speed in which you can complete a BRRRR investment and repeat is key to success, and refinancing with the shortest seasoning requirements is highly important. Loan terms and interest. Cash flow is also an important consideration to a refinanced rental property, so attaining a low interest rate as well as other aspects of the loan structure, term, amortization or interest only, etc., plays a big role. Generally, there are 3 main refinance options for BRRRR method investors: conventional loans, bank credit union loans, DSCR loans. Conventional loans are generally defined as loans originated under GSE, Fannie Mae/Freddie Mac. Conventional loans are generally defined as loans originated under GSE rules and guidelines and securitized. Bank and credit union loans are generally defined as portfolio lenders or lenders that hold the loans on their balance sheet. DSCR loans are loans issued by private lenders with proprietary and differentiated rules and guidelines and are typically included in the non-QM securitizations. The advantage of conventional refinance loans is that they typically have the lowest interest rates and fees. However, BRRRR method investors have run into a lot of troubles using conventional loans for refinances for multiple reasons, especially in 2024. One issue is the challenge of qualifying, as conventional loans will have DTI requirements, income requirements, loan size limits, and loan amount limits that investors looking to scale a portfolio run into as soon as the financial freedom snowball starts rolling. But most importantly, in April 2023, Fannie Mae changed cash-out refinance to seasoning requirements from 6 months to a full year. This is hugely problematic for the speed aspect of BRRRR investing, drastically slowing down the returns and velocity of capital for BRRRR investors using conventional loans. Portfolio lenders are another option, and they typically offer competitive rates and fees as well. Banks and credit unions can also offer flexibility for investors that engage in strong relationship building strategies, offering discounts and solid loans in exchange for borrowers willing to use the institution for other purposes, savings account, etc. However, downsides include regulatory restrictions on bank lending, many institutions that restrict concentration and geographies, and other headaches and issues that arise when dealing with a slower moving bank. DSCR loans are the options that has completely changed the BRRRR lending landscape in the last few years. While DSCR loans tend to have interest rates a bit higher, generally 0.75% to 1% than the other 2 options, which can challenge cash flows. This comes with some advantages that are uniquely suited to the BRRRR method. These advantages of using DSCR loans for refinances using the BRRRR method include more flexible seasoning requirements. As of April 2023, the seasoning requirements for conventional cash-out refinances is now 12 months, but many DSCR lenders are still at just 6 months, with some even as little as 3. Additionally, for rate term refinances, many DSCR lenders have no seasoning requirements at all. Easier qualification. DSCR lenders have much lighter qualification requirements than conventional or portfolio lenders, such as no DTI, income verification, or tax return hurdles that can slow down or disqualify loans. Flexibility. While conventional and bank lenders are heavily regulated and follow standardized rules, DSCR lenders have much more flexibility and control over their guidelines. This allows DSCR loans to be more adaptable to the market as real estate investing strategies change, including the BRRRR method. Some examples of this include being able to embrace the Airbnb BRRRR strategy, not requiring a long-term lease for the rent portion of the BRRRR before approving the refinance, or allowing investors to borrow in an LLC or other creative structures. Easy Street Capital is also the best lender for BRRRR refinances because of our DSCR loans for BRRRR refinances go above and beyond other lenders. We are one of the rare BRRRR loan providers that can do cash-out refinances up to 75% loan to value and 100% of your cost basis back in as little as 3 months, meaning we will use the as renovated appraised value to determine our loan to value, when most other DSCR lender won't use the new value until 6 months have passed. With us, you could have done a whole nother BRRRR by then. Interested in learning more or getting started today? Check the links in the caption below and make sure to like, share, subscribe, and comment all to your heart's contents.